You are watching Daily Market Pulse. This is your Daily Market Pulse for Monday, April 7th, 2026, covering the weekend developments and setting up your week ahead. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Iran just rejected Trump's ceasefire as U.S. labor data masks a deeper recession brewing beneath the surface. Here is the framework for today's briefing. Labor market deception. BLS data allegedly masks 500,000 job losses through reclassification. Iran escalation impact. Ceasefire rejection drives oil prices and dollar strength. U.S. debt soft default. Structural shift toward gold and copper as reserve alternatives. AI economic repricing. Agentic era demands new valuation models favoring Bitcoin. Let's start with what's happening beneath the surface of U.S. employment data. Recent BLS data shows stable headline unemployment, but underlying metrics reveal significant weakness. Nearly 500,000 individuals were allegedly reclassified from unemployed to not in the labor force, artificially suppressing the unemployment rate. Labor force participation has declined to 61.9%, while average hourly earnings and hours worked continue falling. This data manipulation masks a fragile economy operating at what Fed Chair Mary Daly calls a break-even point with zero margin for error. Declining labor force growth historically precedes rapid corporate layoffs and reduced consumer spending, creating conditions for a recessionary spiral. Equity markets maintain artificial stability, but the underlying weakness creates high probability for sharp corrections once corporate margins compress. The lack of genuine labor growth removes the foundation for sustained market rallies. What to watch next? Monitor upcoming labor force participation and average hourly earnings data for confirmation of this trend. Any negative shock to employment could trigger the recession that headline data is currently masking. Moving to the geopolitical front, where Iran's decision is reshaping energy markets. Iran explicitly rejected the U.S. proposed 45-day ceasefire, demanding long-term security guarantees and reparations instead. Iranian asymmetric tactics, including man-portable air defense systems, have successfully downed U.S. aircraft, creating a military stalemate. Trump has set an 8 p.m. deadline for negotiations before potential strikes on Iranian infrastructure. This rejection signals a prolonged conflict where Tehran leverages asymmetric warfare to threaten the Strait of Hormuz, through which significant global oil supplies pass. The stalemate favors Iran's negotiating position while driving oil prices higher and reigniting inflationary pressures that could derail Fed rate cut expectations. Oil prices are rising with WTI exceeding Brent, driven by Strait of Hormuz disruption fears. LNG tankers are already diverting routes, confirming supply chain stress. The ISM Services Prices Paid Index hit 14-year highs, effectively ruling out Fed rate cuts. What to watch next? The 8 p.m. deadline tonight will determine whether we see military escalation or last-minute negotiations. Monitor oil futures and the dollar's reaction, as prolonged conflict could spike energy prices further. This brings us to the longer-term structural shifts happening in global reserve assets. U.S. gross debt is projected to hit $40 trillion, leading to what analysts call a soft default or currency devaluation as the dollar loses Tier 1 reserve status. Central banks and major institutions, including Tether, are net buyers of gold while shifting away from U.S. treasuries. Copper faces a structural supply deficit with 10 to 20-year lead times for new mines. This represents a fundamental rotation from financial assets to real assets, driven by fiscal necessity rather than speculative cycles. The combination of unsustainable debt levels and exponential AI-driven demand for physical commodities is creating a new reserve asset paradigm. Gold and copper are positioned as primary beneficiaries of capital flight from U.S. debt. The market is undergoing a structural reallocation from equities and bonds to commodities, with gold acting as the primary hedge against fiscal instability. What to watch next? Monitor central bank gold purchases and institutional treasury holdings. The pace of this rotation will determine how quickly traditional financial assets face pressure from the commodity reallocation. Finally, let's examine how AI transformation is reshaping asset valuations. The global economy has transitioned from a chatbot era to an agentic era, where AI agents perform work autonomously, driving a 1,000-fold increase in compute demand. This surge is creating immediate supply bottlenecks in DRAM and power infrastructure, while rendering traditional discounted cash flow valuations obsolete for software companies. Traditional equity valuation models are failing because AI disruption makes future cash flows unpredictable, leading to potential compression of multiples for software companies. This structural shift creates inflationary pressure from supply constraints while forcing capital rotation from overvalued equities to hard assets. The speaker from Forward Guidance views current market instability as necessary unwinding of overvalued software equities. Bitcoin is positioned as the primary growth asset because it lacks discounted cash flow constraints and serves as a hedge against fiat system devaluation. What to watch next? Monitor inflation data for signs of the predicted spike above 4% due to AI-driven supply constraints. Watch for equity multiple compression in software companies as DCF models prove inadequate. To wrap up today's briefing, we're seeing a critical inflection point where immediate bearish pressures from labor market fragility and Iranian escalation are creating near-term headwinds for risk assets, while the deeper structural narrative around U.S. debt sustainability and AI-driven economic transformation continues to favor hard assets over fiat-dependent instruments. The 8 p.m. deadline tonight for Iran-U.S. negotiations will likely determine whether we see continued market volatility or temporary stabilization. Thank you for watching today's Daily Market Pulse, and we'll be back tomorrow with your next macro briefing.